Welcome to the Daily Update. This is being prepared Thursday, October 13th, where we'll look at the action in the market today and then see how things look for Friday, October 14th. And I'm recording this at a much different time because of the Mariners baseball game, and they're down 0-2 against Houston now as they head back to Seattle. It's about 4 a.m. where I currently am residing, which would be more on par with how I usually post things when I'm living on the West Coast. So, nonetheless, I was able to work on things during the game and thought that I would go ahead and record this and post this earlier than usual. So, let's go back and talk about things for Friday, October 14th by looking at what happened on Thursday, the 13th. Right at the open, the CPI came out and it was a lot hotter than expected. And we had a massive gap lower. We actually gapped down right at the open to S3 at 35.17. And then we fell even below that to just below 3,500. Well, that was the 50% retracement that we've been looking at. It's below the 200-week moving average, but it's also right in the middle of the retracement from the COVID lows to the all-time high. And the market was able to find support right in that area. And boy, did we turn around and go in the other direction. As the day went on, we found support. We broke back above S2, S1, the pivot unchanged, R1, R2. We went positive and we climbed to almost R4, which doesn't happen. Now, the reason for these small ranges is because Wednesday's action was so minuscule from the high to the low. And that's where the pivot points are calculated, is on the previous day's action. And so for us to hit these levels on a big swing anyway, just makes it so that we're hitting levels that we usually don't hit. But it's pretty much normal. We had a really quiet Wednesday in anticipation of the news coming out. And then when it came out, it was negative. They found support and we turned around and went back up. And we didn't quite get to R4 at 36.90. We're just a bit underneath that. We did close a bit off the high and we were up 2.6% with above average volume. And the technicals, they're still negative. We've got a lot of work to do. But coming off of that support, looking at some of our setups, if any of you've watched the Larry Williams video, the idea of these cycles going through, I think it's the decennial cycle every 10 years or so, but it's years ending in 2. Now, he didn't really give a time factor for that. He was just suggesting that there's a chance that at some point we'll hit support and then be able to go up off of that. We don't know. This could be it, or we'll bounce a little bit and then head down even lower because there's still so many negative things that directly influence the market. Because the markets, when they're going up, they do climb a wall of worry. This isn't worry. This is nightmare reality that's going on not only in the US, but around the world right now. And with the Fed working against what the market really wants, that just adds, it doubles the pressure that the market's already dealing with. So we have to be suspicious of this. We have to see if there's going to be some follow through to this nice bounce. We're going to have to see some confirmation, and it's going to take some time for that to work out. Or was this a dead cat bounce? We're just going to bounce up, work off the oversold condition, and then start jetting back down lower again and even hit more lows going forward. Even though with all the other news events that are going on, inflation and interest rates, that's what the markets continue to be fixated on. Even though there's the Russia-Ukraine situation, the UK's kind of acting weird again. We've got earnings season that's just really starting to pick up right now. Anytime along the way, some Fed speak could come out. And the Fed speak has been negative for the most part, especially if we're paying attention and trying to follow what Chairperson Powell is saying. If there's even a hint of some kind of pivot in what he says, if he says anything, that's really going to give some support to the market. If he comes out with this more hawkish stance that he's been doing all along, that could really shut things down from having a chance to go higher. So, what are some comments that we can make? The CPI did come in greater than expected, and at its low, right after the open, the S&P was down 2.4%. My gosh. And then to finish up 2.5%. I mean, that's a monster intraday move. And then we rebounded at that 50% long-term fib level. And I'll show you that. I do have a chart to show you. Also, coming out of the UK, there were some reports that Prime Minister Liz Truss, she might scale back the fiscal stimulus plan, which is basically quantitative easing again. And this gave a lot of relief to the gilt market. That's what they call their bonds, and to the British pound, after we've seen it really going crazy lately. And their 10-year gilt, or their 10-year bond, their yield, it fell 33 basis points to 4.19% when this news actually ended up coming out. So that was seen as more positive in the UK from a financial standpoint, and that really gave some support over into the US markets at the same time. And one thing that I did notice, this was not a growth bounce that we saw in Thursday's session. This was more of a value bounce. Our sector rotation, they didn't improve. And I'll show you those charts, but value really led prices quite a bit higher. And the Dow really led the way too. We haven't seen the Dow be a major leader very much in 2022, but it was up more than the other indexes. We still have our same yield curves that remain inverted. Sentiment, even with the update, we're still tilted over into the extreme fear camp. And then this is the CPI report, the total CPI, the headline number. It came out at up 0.4%, which is double what they expected, up 0.2%. When you take out food and energy, and this is the real focus for inflation, it rose 0.6%, where they expected it to be up 0.4%. So that was more than expected. And that's why everything tanked before the market, or with the futures. They just really started going down. And that's why we had the really big gap down open. On a year-over-year basis, the CPI is up 8.2%, where the last time we had this report, it was at 8.3%. So, who knows how the politicians are going to twist this around and say, well, it's declining. Well, yeah, but look at the level that we're at. And then the core CPI, it was up 6.6% on a yearly basis, where the last time we got this report, it was coming in at 6.3. So that actually went up, where the core CPI came down. And that's what they'll take this to manipulate that. They'll focus on the headline number and kind of forget about the core one, unless it works in their favor. That's how politicians can basically tell you the truth, but be completely inaccurate in how they're portraying things, because they don't tell you the real story, or they're spinning things around to make themselves look a little bit better. And I'm not blaming Democrats, Republicans. They all do it. It's part of politics. Jobless claims also came in. This is one of the closer reports than what we've seen in a while, at 228,000, where they expected 225,000. There had been a much wider gap over the last number of weeks. Our trend is still negative and getting stronger. We haven't seen enough of a bounce yet to really bring the ADX down. The red line is still on top, and we're still above 20. So that is still negative overall. This one-day bounce, I'm really leery of switching the bias over to positive. Now, you can probably take that as positive, and we came up off support, and this might be the start of something significant, but we just need to see more confirmation. I'm still keeping our momentum as negative as well. And I probably should have changed the bias to positive, because that's usually a day by day adjustment. If we have an up day, the bias is positive. A down day, the Okay, let me try that again. A down day, the bias is negative. So let's go back and talk about the day sentiment. Even though we're bouncing up a little bit, we're still at 24, which is below 25. And here's the historical chart of that right now. Because I haven't done any full-blown videos over the last couple of days, there'll be some extra charts. I weeded out some of the Isabel net charts so I don't spend all my time just going through those. I just tried to look at the ones that are either interesting and might help us a little bit, but the ones that are really telling us things we already know or that really aren't relevant to our situation, I've cut those out. But we did get the latest reading for individual investors. Now, this was a week ago when they were feeling this way, and they remain extremely pessimistic. And I mentioned this in the daily brief in Thursday's video, but I didn't show you a chart. And this could be positive for the market. But we've been bouncing around down here before, coming back up and then falling right back down into this. So we want to see, can this continue? Here's another look at kind of that same basic measurement where we were getting pretty extreme negative down here at 18.17. That is a very low reading. When it gets to be this low, we are oversold, and we use this often to as a contrary indicator. Another thing is slowing global M2. That's the money supply. And we're looking at the globe, not just the US. There's just less money out there as they're pulling in some of the reins. Now, the UK is its own story. There's some different things going on in Japan. But when you're talking about the US and the EU and other parts of the area of the world that are pretty economically significant, we're seeing the amount of money really starting to decrease, and the S&P is really starting to decrease with that. And that just goes back to the same thesis basically that we've been working with, is why did the market go up as strong as it did after the COVID plunge? It was because of quantitative easing, and they were buying into bonds. That was keeping interest rates really low. A lot of that money found its way over into the stock market. People are buying, buying, buying. It was turning it into a cash machine. Buy the dip, buy the dip, buy the dip. Well, this year has turned more into a bottomless pit rather than a dip at this point. But it just shows how these tend to go hand in hand with each other. This is showing the preseason cut to the third quarter estimates. Again, we're just starting the fourth quarter now, and they're down 7%. And this is one of the largest outside of when we had the whole COVID plunge. And here it is right down here, how they've really been shutting down or lowering their third quarter estimates right now. And if you take out energy, it's down even more, down over 8%, because energy has been the one sector that has actually been going up. Our sentiment indicator, this isn't as negative as some of the other indicators that we use, but it was getting a little bit down to more the extreme negative side of things. This is just showing you the households, foreign investors, and institution. 93% of stocks as of the second quarter. This just shows that these are the folks that own them. Of course, I'm trying to figure out what are the other 7%. They say it's business holdings is 4%, and then this other. And I have no idea what other is, but this just gives you a breakdown of the different areas. And they valued this at 63 trillion, which is basically double the debt that the US currently has right now. Then another thing that they're playing with as a scenario is, perhaps if we see some growth going forward from here, it's going to come from the old school stocks like the energy, materials, industrials. That's the blue line, where they've really apparently hit some kind of a bottom here and are coming back up, where the tech, discretionary, and communication, they have really topped out and are starting to come down. So are we going to see things revert back to more of a value play, more of the old style of investing, or here they call the old economy sectors? This is a capitulation indicator. It takes into account breadth, trader sentiment, insider sell buy ratio, as well as momentum, puts them all together. And again, this is a couple days old, but this was just confirming what we were already seeing, is that the market was getting extreme negative. And then these are the S&P 500 returns by year of the presidential cycle. And right now we're into year 2, and they're saying, well, we might get 1% as our return. And then the blue line, 57% of the time, are the number of years with a positive return. Of course, that means that 43% of the time there's a down return for the year. But then in year 3, this ends up being one of the stronger years, at least on an average basis. And that could be, if we start to get a bounce coming up out of this, and then we get through the election and we still see some support going into the end of the year, this is what the markets now are looking forward to, is 2023, because they always look forward into things. And it just means that 95% of the time since 1932, the third year of a presidential cycle has been positive, with the median average being 17%. Here's another chart just looking at some different growth projections, where the global economy in 2021, it was at 6%. This is like global GDP. Then it was at 3.2% for this year, and they're projecting it for 2.7. So they're still positive on things, but it is coming down. The advanced economies, that would be like the US and the EU countries, 5.2 for 2021, down to 2.4 now for this year, and then 1.1 decrease, but still positive overall in 2023. Emerging and developing economies, they were really up strongest, and that's why a lot of folks really like that EEM ETF, because this gives you emerging market exposure. It was up 6.6, where they're thinking it's going to be 3.7 both in 2022 and into 2023. This just says not many green days in 2022 so far. Way over here on the right side, this just shows the number of percent of days higher per year for the S&P, and it's really fallen off, where this is what we had been seeing right in here. Well, that's really dropped off, and that shouldn't be surprising based on what we've battled with so far this year. This is a chart that's updated as of the end of September, so it's a little bit old. This is just showing the Russell 2000, which are small caps, against the Russell 1000, which are the large caps. And it shows how the small caps have really been underperforming, to the point where they're now considered to be cheap when you're looking at their relative forward PE ratio. And we've been talking about this. I keep talking about, let's see some support from small caps. Well, it looks like we're getting some of that now. We just need to see if it can continue. Then this just shows corporate profits after tax and real GDP, where, let's see, the blue line right here is the S&P and how it's been going down and bouncing up a little bit. This is also a little bit old. And then this kind of cream colored line, I guess, these are corporate profits after tax with inventory valuation adjustment and capital consumption adjustment, a bunch of accounting terms. Just, and they use these to make things look a little better than they really are. But this just shows how corporate profits, they're down, but they still continue to rise overall. This is looking at the forward PE ratio recently, whereas the S&P has been coming down, even though we're seeing the earnings revisions coming down. We're right in about close to about the 15. Well, here they have it at 15.2. And that would be considered fairly valued on a forward-looking basis. We're still very overvalued on a historical basis by looking backwards. But as I always say, the market does look forward. And now that we're down to a more fairly valued level, at least going forward, we could get some bounce out of this and justify it because of the earnings revisions. Then a lot of companies are blaming the foreign exchange rate right now. That's providing a real headwind. And this is just saying the estimated currency impact to quarterly earnings on a year over year basis in the fourth quarter this year, as well as the third quarter. Okay, I guess that was the fourth quarter of '05. Yeah, going back to 2005 up until the third quarter that ended in September. And this is what's putting a lot of headwinds into the market now because the dollar is staying so strong. And that's really hurting corporate forward looking earnings. Now, this is the report that comes out every month. And as I explained, we have the number that the government gives us. Well, if you go back to how they used to calculate this in 1990, we would be up a lot higher now, probably 13, 14% interest, or I'm sorry, for as far as an inflation rate, where this orange yellow line, this is what the official number is that we were given. Then to make it even worse, if you go back to how we calculated that in 1980, we're still up in the 16, 17% range as far as inflation is concerned compared to the official number, the red line that we were given. Here's the latest reading of the bear bull ratio. These folks just can't seem to get a break these days. Now, this is a couple days old, but it seems like they're getting into bullish funds when we're going up and getting into bear. They're doing the opposite of what you would think that they would be doing during this time. And that's what people that react to markets tend to do. That's why we try to look ahead and develop a plan and develop scenarios so that we can see things unfold and then just go with that. Here's the look at Thursday's session, and you can see how growth was up, nice, 2.45%, but it's not as much as value. And the same thing is true with the mid caps and even with the small caps. So this was a more value-led bounce. Now, other times when we've seen a bounce like this, it was led by growth. Maybe this will help things a little bit, get value back up a little bit, and then growth can come in and take over. Just an idea, just something to watch for. With the up day, where we ended up closing up on the day, the VIX did drop on the closing basis, and we closed just about at the lower end of the bar on the bar chart. The Ulcer Index is back down to the midpoint here, right at the moving average. I don't think that's necessarily accurate based on other things that we're looking at. We're still a lot more fearful. The VIX of the VIX also really dropped as the VIX went down. We're down 23.84% from the all-time high. And the equity put call ratio on the daily chart did decline slightly. 5 periods, we still are working off of the spike, and it's still going up overall. If we continue to see some more follow through upside movement, then we would then anticipate this 5 period SMA to start moving down. Here is the pivot levels for Friday's session, and they've been posted on the YouTube channel under the community tab. Here's the daily chart showing how we broke down below this support, and then we closed back above it in today's session on a real increase in volume. This is the other chart that's good for the whole month of October, just updated with the candlesticks here. And these are the pivot points. And then we came down just about to this 50% retracement level. And this is where the markets were able to find some support and then bounce up off of that. And that's long-term solid support. And this is on a daily chart. And we're seeing kind of the same thing on the weekly chart over here, where we came down to this 50% retracement, bounced up off of that, came back above the moving average. And this could end up being a nice positive bounce if we see follow through buying. We're coming up a little bit closer to the midpoint of the trend channel right now. The sectors, all the sectors were up, led by financials. We haven't seen those in the lead for a while. Energy had a good day, tech, materials, everything. The thing that was up the least was discretionary, and that was up over 1%. Our scooter score still just has the energy sector in the 99 range. And we have real estate still in single digits at 7.7, where communication is showing a little bit more improvement. I think it was at 10.5 yesterday. It's at 12.2 today. Here's the energy sector, which is still going back up and looking a lot better. And then you have healthcare, which has been going down, and utilities has actually dropped now into third place. And then all of the other sectors are still decidedly negative. Here's just an update of the percentage changes since the pink bar, which is the S&P 500, made its all-time high way back in January. Technical alerts, I had to really scrunch this one down. And there's just a whole plethora of things here. As we were going down, 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 down with that huge gap, we were just all kinds of technical alerts were being triggered. But then when we started to bounce back up, we saw the S&P got back above 3,600. The NASDAQ got above 10.5 and 10.6, and the Dow got back above 30,000. The Dow is now in first place. It had a really good day and really led the way higher. It's at 67.8, followed by the mid caps at 64.7, the small caps at 62. The S&P still doing better. It was up 5.8 for its score, but it still needs a lot of improvement. And the Qs also improved, but they're down at 22.6. Here's the intraday chart and see how flat things were on Wednesday. CPI came out and boom, we just tanked all the way down to S3, which I had to put on here myself. We came all the way down, even dropped a little bit below 3,500. That's being the 50% retracement. And the buyers just flew in at this point. Took us back up. We got above S2, S1. We went positive, broke above the pivot, and then went above R1, R2, and almost made it up to R3 before falling back going into the close. So that's just a monster move here. Our trend, it's still going up. It hasn't really picked up this upward movement yet. So the ADX continues to get stronger with the red line going up. And so that is a negative trend. And we're also above 20. The Arun is still looking pretty extreme negative. It hasn't really picked up what we're seeing in the form of the bounce because these are prices we were at very recently. Breadth still has a long way to go, but we saw a major up thrust day based on price and volume. So we did turn back up, but first thing is we need to try to recapture those moving averages. Advanced decline ratio after getting extreme negative is now turning back up. New highs, new lows. See, look at how the new lows really expanded. When we were setting all those 52-week lows and all the different stocks in the S&P 500, this might be considered like a washout with new lows, but it's going to take a while for this to turn back up. We're still pretty much flat, and we've turned down with the 10-day differential. Accumulation distribution did turn up, but we're still below a declining moving average. Short term, we might have overdone it to the upside based on the advanced decline ratio, based on the 1-day rate of change, 5-period rate of change. After being extreme negative, we're coming up out of that now. The Stoke RSI, this thing is so touchy. It's already trying to get back into extreme positive territory. The Williams percent R, which is usually pretty touchy as well. In fact, the videos that I'm mentioning, this is the gentleman that developed this indicator, Larry Williams. It is looking a little more positive for this one. The force index is not extreme right now and did see a nice little bounce. The Swindler trading oscillator based on price and volume did turn up. McClellan oscillator is still negative, but showing some improvement. And our 20, 50, and 200-day moving average studies did turn up with the up day. The stochastic for the short term, that's turning back more positive. Intermediate term, we're coming out of an extreme negative reading, and we're still declining with the long-term stochastic. Rate of change going back 20 periods after being extreme negative, we've now worn that off. Going back 50 periods, we're still in extreme negative territory, but we're starting to turn up. The Sean trend meter also coming out of an extreme negative reading. The PMO, even though it's trying to turn back up again, is still overall negative. Our PMO study is showing an improvement with the PMOs that are rising, and the buy signals are improving, and we turned up just slightly with those that are above zero. And this is a pretty negative, extreme negative reading still. Chicken oscillator also turned back up. Chicken money flow showed some improvement. Volume did pick up, so that's why you're seeing this black line turning up. The vortex, even though it's declining with the red line and advancing with the green line, it's still negative overall. The summation index based on price is still going down and looking extreme negative, where we're trying to turn back up based on volume. And sometimes this is a leading indicator, is the volume part of this. And then we're still seeing kind of a mix. The slope is still turning a little more positive. The MACD's trying to do another crossover here. We're pretty much flat with the KST and the tricks. The PMO is still slightly negative, and the TSI is just kind of floundering. So we're seeing a real mix with our oscillators. The BPI, all of these signals were generated right after the open, and the ease of movement ended up showing some improvement. The ultimate oscillator also some improvement. Money flow index improved. We're coming out of an extreme negative reading with the boom indicator, which measures the distance between price and the 50-period moving average. And we're looking a little bit better when we look at price and the difference between price and the 200-day moving average. TTM squeeze still a little bit confused right now. It's going up, which that seems more logical. But as we were going down, this histogram was still continuing to go up. Balance of power has shown some improvement. And this one's kind of crazy. After generating a signal, the early didn't lead to anything. It dropped back down. It gave us a sell signal. Well, now it's going back up. So we'll just kind of leave this one off to the side for now. The Heiken Ashi looking more positive, even though it is still negative. And we have a red line with the Kegi chart. That's still negative. The Renko is still negative. 3-line break is showing some improvement with an open bar. And the point and figure chart did place 2 new zeros in here. That was right after we opened. And it didn't register any of the rebound in here because we didn't gain enough to the upside. The elder impulse for the S&P is back to neutral, as it is for the SPY. The SAR continues to be on top, so that's negative. And our go no go system still continues to be a deep purple, so that's negative. Longer term, we're seeing a bit of a turn up with our 50, 150, and 200-day moving average study. Rate of change, we're still looking extreme negative, but could be starting to turn back up. The special K is also starting to get down to an extreme negative reading and could try to turn up, but this thing is very, very slow. This is like a big cruise ship or a big tanker. It just takes a long time for this thing to change direction. The diamonds are back to positive with the update because the Dow really did lead things higher. And here we went right back up on the Dow to settle right above the pivot. And the Qs are back to neutral, and they're still showing a nice bar here, but we really haven't recaptured anything to this point. And with the down day, we've got this funky looking Vixen bar coming down here and a bit of a decrease on the line chart. The NASDAQ also didn't really recapture anything yet, but we are seeing some improvements there. The mid caps are right back up to almost the pivot point. And the Wilshire, broader based, also looking a little better. Dow theory, we saw the upward move with the Dow, the transports, and the utilities, which had just been getting hit. They did see a bounce in Thursday's session. The dollar, because stocks were up, the dollar was down, but we're still in an overall uptrend. And the S&P to the dollar index, they're going in opposite directions now. Gold, gold just seems to go down. And silver was also down. Oil it was up and we're at 89.11. And the correlation between the S&P and oil is neutral right now. Looking at bonds, we saw a little bit of a bounce here, but we still were down overall with the bond ETF. And we're coming down and matching the low with the Pring World Bond Index, which is even below the COVID low. Here's our look at our yield curves. The 10 to the 5 is inverted. The 30 to the 5 is inverted. The 10 to the 2 remains inverted. We still have not gone inverted yet with the 10 to the 3 month. And here's all the different yields as they're going higher, with the 2-year still giving you the highest yield. Looking at some correlations, stocks and bonds still having a tendency to go in the same direction, even though that could be wearing off slightly. The S&P to the 2-year also working its way more back to neutral, but having a slight tendency to go in opposite directions. The S&P to the 10-year is still a little bit more to the opposite or inverse side of their relationship. And the tech sector to the 10-year also having a tendency to go in opposite directions, but not as strong as it had been. Here's an update of our possible positive scenarios. We came down and set this base, and we're bouncing up out of that with the percent of S&P 500 stocks that are above their 200-day simple moving average. When we're looking at the 50-period moving average, that did make an improvement with the S&P, the mid caps, and the small caps. The 10-day average of the highs and lows hasn't really changed yet because we're still setting a lot of new lows right now, really no new highs. And then the broad market measurement of the highs and the lows over 5 periods is starting to show some improvement after really going extreme negative. Here's the spike with the equity put call ratio, and we are coming down with that since the equity put call ratio has been declining. Small caps did regain this pivot level here, and the S&P ratio to the small caps, it was down just a little bit, but it's been breaking out over the last few days. And so we're seeing a little bit of a spike up here in the red chart. If that can continue, that could give some support to the blue chart, which is the S&P. Our rotations, they're still up. Down here at the bottom, right here, we're still headed in the right direction, but we're losing a lot of that direction now. So it's showing some weakness in pretty much all of these charts right now. Doesn't mean that we wipe this out, because unless we take out these lows with these ratios, they're still in play. This has been encouraging too, where the S&P utilities ratio has also showing that the S&P has been outperforming utilities. We're just going higher and higher with our 2-year yield, so we don't know if this is a spike or not. The sectors were also up, and after almost coming back up to this spike, it did decline a little bit. Are we going to take out this spike, or is this going to start to fall again? Every time it falls, that gives more validity to this, giving support to the S&P 500. Coppic curve is still generating a signal, and the Pring bottom fisher is also still generating a signal. So what's our outlook? We are negative, but improving if there is follow through. If this is a dead cat bounce, if this is just a one-day wonder, if we can't really build upon this, and we're going to have retail sales coming out, if that gives some support to the market, we could see some follow through action. If we don't see it, then it's going to be really hard for our technicals to turn over positive. We do have retail sales, import, export prices, business inventories, and I think it was consumer sentiment is coming out, but I didn't see that in the list. The whole list of geopolitical events, Russia, Ukraine, the things going on in the UK, any Fed speak that may come out, but inflation and interest rates are what the markets are fixated on. We still have to go with the down scenario because our technicals are negative, but they could be starting to improve. We can't really justify the up scenario, even though things are looking like they're improving. But one day, even a really solid update like we saw, we're going to need to see more than that. And because the ADX is above 20 and advancing, we can't really go with the sideways scenario right now. So our conclusion, the S&P is negative, but might be rebounding. Short term, negative, but could be rebounding. Intermediate term, the same story. We're still negative with the 200-day moving average. So thank you. I hope this was helpful to you. I will look at preparing the weekly video and the intermarket analysis video, as well as the daily video for Monday. I'll be doing that over the weekend.